Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. Today we'll decode what investors should be looking at if they're looking at business cycle funds. Remember, the sectoral funds, they've seen a big surge in terms of inflows. We want to understand the pros and cons of it. Business cycle funds would be a subset here, the returns and more as well. Joining me today is Bhavesh Jain, co-head Hybrid and Solutions, Edelweiss Mutual Fund, and Prableen Bajpai, founder of Finfix Research and Analytics. Bhavesh and Prableen, good afternoon. Thank you so much for joining us today. We're talking about this topic at a time when sectoral, thematic funds, factor-based investing, all of it are the buzzwords as well, right? So, Prableen, let me start with you. Let's talk about the basics first. Can you help us understand what exactly is a business cycle?
Good afternoon, Sonal. Great to be on your show. And I absolutely agree with you. With the huge inflows coming into the thematic and sectoral space, it's exciting as well as scary at the same time. Coming to what a business cycle is, so it's at different layers, basically, Sonal. And it starts with the economy. So an economic cycle or a business cycle has its different phases where we see the growth of an economy through different phases of expansion, contraction, recession, and so on. And the same thing percolates down to different sectors as well. So, during different phases of an economy, there will be different sectors which behave differently. And then they have their own growth journey through these phases of expansion, peak and contraction and a trough. So a business cycle is essentially this movement, this cyclical pattern which happens in all economies, be it global, be it domestic, all the different sectors. And even companies, they go through this, and the essence of this category is broadly to capture on the information. The fund manager knows what phase are we in an economy, how different sectors are going to perform, what is the phase that a specific sector is in, and of course they don't move in the same pattern at the same time. So let's say if a particular sector is going through an expansion, there may be a peak in the other sector, and this is what is put together, and that is what the business cycle funds are actually trying to capitalize on.
Okay, so does that mean they can change the sectors according to the business cycle? How does that exactly work there, Prableen?
Yes, absolutely, Sonal. So I'll call the business cycle, it's like the flexi caps of the thematic space. Just like a flexi cap fund can move across large caps, small caps, and mid caps. Of course, a business cycle fund will have the flexibility to move across the market caps, but a sectoral fund or a thematic fund has some sort of a commitment to a specific sector. Sectors are, a smaller component. It's a narrow theme. Then we have these regular thematic funds where, let's say, if you're talking about banking and financial services, it's still restrictive. But the business cycle fund is like the flexi cap of these categories. So it has the, mandate to move across different sectors depending on where the fund manager sees the potential. So I would say it's a diversified version of, the sectoral and the thematic category. And I think that is why, we are seeing more and more inflows coming in, Sonal, into this specific segment as well. And I think it's a slightly lower risk version as well as compared to a pure thematic or a sectoral fund.
Okay, all right. We'll discuss about what's happening right now in just a bit as well. And I would like to get Bhavesh into the conversation as well. Bhavesh, there's an Edelweiss business cycle fund. I just want to understand from a fund manager's perspective, is it the right time to launch a business cycle fund? Don't you think we're already at the peak of the cycle for many of the sectors, even if you want to choose one? What's your take here?
Thanks, Sonal. Good afternoon, everyone. Yes, if you will see, as Prableen rightly said, a business cycle fund try to first take that macro call and then select which sectors will move, and then finally comes to stock. But that is one way of looking at business cycle fund. At Edelweiss, as you all know, we are always known for launching, you can say, products which are having similar name, but actually are quite different from what 90% of the industry is doing. So as you rightly said, today when markets are at lifetime high, a lot of sectors are already going through the roof. That question mark will always arise whether this is a good time or not a good time. But for that, first you have to understand that we are launching a business cycle fund which is totally different, where neither we are trying to predict any macro cycles, neither we are trying to predict which sector will do well and whether any particular sector is still cheap or still attractive and all that stuff. We are just going on the other way around. First, we are selecting stock, and then effectively that will get converted into sectors, and then it will become a macro call. So ours will be a bottoms-up approach compared to a top-down approach, which is being followed by, you can say, almost 90% of the funds in the industry. So here we are, you can say, more dependent on factor-based investing, wherein we are, you can say, giving more emphasis to factors like growth, value, quality. But along with that, we are also focusing on momentum. So we think that momentum will help us to navigate from one sector to another sector, and thereby overall, if you will see, it will reduce our volatility compared to the benchmark, and it will help us to generate a decent alpha compared to the benchmark. So we are totally into a different way of managing a business cycle fund compared to any other fund in the industry.
Okay, just a follow-up on what you just said, Bhavesh, since you're saying you are following the bottom-up approach here, then can we say in this kind of a fund, it is not like any sectoral funds because it would not focus on a particular theme and it would not focus on a particular sector? Is that a fair assumption?
Yes, perfectly. You can say you rightly got it. See, right now the biggest problem with any sectoral fund is entry is very easy. As we are saying, you can say not only flurry, even a tsunami of NFOs on sectoral fund. Entry is very easy. Today, someone is launching, say, a defense fund, or say, for that matter, an energy fund or a tourism fund. You can enter into that particular sector. But what about exit? Neither a manufacturer like MF will give you an exit call, neither the client himself will take an exit call because of taxation, and similar problem with distributors also. So exit has always been a challenge, and we have seen enough data is there. If you stay invested in a sector for a long period of time, chances are you may end up underperforming any benchmark also. So sector allocation or sector fund are purely tactical in nature, and that's why entry and exit both are equally important, and that is where our business cycle funds come handy. Right now we don't know which sector will perform future, and that's why we keep on navigating from one sector to other as and when momentum will help us to navigate, looking at other factors like growth, quality, and value also.
Okay, I get that point. And considering the kind of inflows we've seen, it's also time to be a little cautious, right? Prableen, your take here. First up, are there any advantages of a business cycle fund according to you? Why is it good to have a fund like this on your portfolio? And at this time, do you think it's the right time to look at this category?
So Sonal, the first part, we are actually seeing that investors are loving the sectoral funds. And of course, that is because of the phenomenal growth that we've seen and the returns which are there on the, already what we've seen in the last 1 year or 2 years. And with 55% of inflows coming into the thematic and sectoral space, out of the total net inflows in the last month, it definitely shows that people want to invest in different themes. And that is because, they are probably trying to move away from the general products that we have, which is the regular large, mid, and small caps. Now, having said that, like Bhavesh mentioned, it's really most of the times what happens is that when investors are entering a sectoral fund, the sector is already peaked, or they've seen the performance, and that is when they invest. And of course, then exiting, or it's if there is a correction, it's a hard fall for them. So I think where the business cycle category or these funds can fit in, I think it's a better way to take exposure to different sectors where, so like a diversified fund will also take exposure to different sectors, but a business cycle fund can take more aggressive calls. For example, there were funds in the business cycle category which had, up to 40% in metals as well. They have, they can have a higher concentration to specific sectors which they feel would continue to perform. So for investors who are looking at multiple sectoral funds in their portfolios, and are really not sure, they are just looking at returns and kind of adding those funds to their portfolio, probably business cycle fund offers a solution. It definitely diversifies their exposure within different sectors, but doesn't dilute it too much. They are still concentrated portfolios, and then the fund managers there to look at the economic cycle and what is good in terms of exposure. At the same time, given the current market levels, I think investors need to do their recalculations in terms of whether this category would add value in their portfolio, if they're already placed well in all the other categories of the diversified categories like the large, mid, and small, or the flexi cap funds, then definitely. But Sonal, having a long-term view is important, and what we've seen in the past, the returns can't be replicated. So it can be an addition for investors who are looking at slightly aggressive bets and are not able to decide, which sector to add, which theme. So at the top is the sectoral funds most concentrated. Then within the sectoral thematic, like I said, are the themes, and then comes the business cycle. So it's a more moderate way to add and take a sectoral exposure.
Okay, take that point. Just taking it forward, Bhavesh, this category has seen a pickup since 2021. You helpfully provided us data as well there. At that time, we saw lower valuations, but some trends are still picking up, be it new energy, be it segments of markets which are still seeing valuation comfort, reasonable levels. So are these fundamentals still relevant? What would the constituents of your business cycle fund be in that case?
So if you ask me, our business cycle fund will be more like a balance advantage fund, where in balance advantage fund, a model helps you to dynamically move from equity to debt and debt to equity, because we have always seen that human biasness is not able to take those right decisions which a model driven thing could take. And that's why when it comes to Edelweiss business cycle fund, it is purely a model driven business cycle fund, wherein the model will help us to move from growth to quality to value along with momentum. And this movement of, you can say, sector is more in a rule-based environment. So the biggest problem which we face today is whether valuations are expensive or not, whether we will see a correction or not. If we think from, you can say, purely from, you can say, traditional approach, we will not able to buy a lot of stocks at today's valuation. But when it comes to a model driven approach, I think this emotional biasness and our belief that market cannot go beyond a particular level are taken care of, and the model itself will help you to navigate from one sector to other. We have seen historically, see, the biggest fear today is if market corrects from tomorrow, and if the correction is there, all the sectors, all the funds will correct. But when we did backtesting for our business cycle fund over the last 12 years, we have seen 10% plus correction in Nifty 500 TRI index. And when we compared our model-driven portfolio backtested performance in those 9 falls of 10% plus, I think our fall was not different from what index was doing. In fact, we were, you can say, in the range of plus or minus 2% of index fall in all the 9 falls. So if market corrects, all your fund will go down. Along with that, business cycle fund will also go down. But we don't know when market will correct. We have seen historically from last 1 year, a lot of funds in small cap stop taking, you can say, inflows. And that period, small cap index from around 11,000, today is at 19,000. At 11,000 also, we were worried that tomorrow there can be a fall. And at 19,000, we are equally worried that tomorrow there can be a fall. So that's why we don't want to predict. We don't want to, you can say, in a way, try to, you can say, forecast that what will happen in next 3 months, next 6 months, next 1 year, because we have seen individual expert of their, you can say, individual fields are not able to predict what will happen in next 3 months to 6 months. And that's why we also don't want to get into that business of prediction, and we will stick to historical data. That's why we will look at growth score, we will look at value score, we will look at momentum score, all which is dependent on historical data rather than preempting or predicting anything in future. So a rule-based approach will help us to, you can say, bear this volatility as and when it will come. When we look at our backtested performance, again, historical data, Nifty 500 TRI, which is the benchmark for this category, has a standard deviation, or you can say volatility of around 16.5%, whereas our portfolio has a volatility of around 15.5%. If you look at beta for our portfolio, it is again 0.82. So we are taking much lower volatility, much better, you can say, protection on downside, much lower drawdown, and are able to outperform the markets. Then anyways, as I told you, this is not a product for a 6-month or a 1-year investment duration. It is a sectoral fund end of day, and we are trying to move from one sector to other. So ideally, the invest period is minimum 3 year to 5 year. And even in short term, there can be correction, there can be, you can say, pause, there can be some falls or some time correction. But if you take a 5-year view, we don't think that markets are extremely expensive with the 5-year view. In you can say that is the ideal period what we are thinking that one investor should look at when it is looking at any sectoral fund or any business cycle fund.
take that point. It's just the worry is that some of the retail investors, the majority of them who came during COVID, are not looking at those longer term periods. The immediate gain, that theory has gained a lot of popularity, and that's causing the worry that, the experts or anyone has with sectoral funds. We take that point, but we have to get into a quick break. On the other side, we'll continue our discussion with our guests on business cycle funds and more. Stay tuned. Welcome back. You're still tuned into MF Corner. We have with us Bhavesh Jain, co-head Hybrid and Solutions, Edelweiss MF, and Prableen Bajpai, founder of Finfix Research and Analytics. And we are continuing our conversation on business cycle funds. Bhavesh, let me come to you. You did speak about there can be ups and downs. But overall, does this category always outperform? There must have been instances of underperformances as well. Can you explain what should an investor be aware of when it comes to cyclicality in this particular category?
Yes, finally, business cycle funds are trying to, you can say, move from one sector to other through a model. Now, if there is no trend in any market, or handful stocks are, you can say, driving the entire rally in the market, like we have seen in 2018, where few 5 or 6 stocks were positive and the entire market was negative. So you will underperform in those kind of environment. Similarly, 2022, where there was no clear leadership. Every 3 months, every 6 months, we kept on saying sectors were rotating very aggressively. So there was no big trend in market. Even in that kind of environment, this fund tend to underperform Nifty 500 TRI. But if you will see, underperformance in those years is, say, quite manageable. It is in the range of, say, 2 to 3%. But in the years where we are seeing big trend in market, like what we have seen in last 1 year in capital goods, before that during COVID in pharma and IT, if you are able to identify the right cycle or a right sector at the right point of time, I think there are enough ways to, you can say, generate reasonable alpha. What we always say is, rather than looking at point-to-point return, you should always look at rolling return. And whenever we look at rolling 3-year and rolling 5-year return of, you can say, the back-tested model, it has been able to outperform Nifty 500 TRI anywhere between 5 to 7%. And as I told you, it is almost 95 to 100% of the time that the model is outperforming the benchmark. If you see, finally, it is an equity product. If there is a prolonged bear market like 2008, 2011, or a COVID fall like 2020, when we did again the same similar backtesting we have seen in a fall of COVID, when the broader markets were down almost 38, 39%. This fund, the model portfolio, would have been down by close to 33%. So the beauty of a factor-based investing or a model-driven portfolio is you can actually go back in time and test your model at that point of time, and you can say generate that NAV series, and you can test what could have been your performance in bull market, bear market, sideways market. And I think in most of the market scenarios, a model driven approach is able to outperform most of the other categories in the market. When though the name of the fund is business cycle fund, we have also compared our performance with other flexi cap funds in the market or other large and mid cap fund in the market, because our construct also is 50% into large cap and 50% into mid cap. So we have compared with large and mid cap index and large and mid cap, you can say, actively managed fund also. So the results have been quite positive, and then most of the time period we have seen with almost similar amount of volatility what a normal you can say a diversified fund would have. With similar volatility, we are able to, you can say, generate decent alpha, because as I told you, the entire you can say the model is driven through momentum, and that has been doing extremely well for last almost 10 to 12 years, and that is, you can say, our secret source of success.
Okay, I take that point. Prableen, would you say such funds, first-time investors should go for it? How much should it be as a percentage of your overall portfolio if you're starting out or you've been in the markets for some time now?
I believe, Sonal, that it is not a category which is for first-time investors. I think it's better to start with the regular funds which are there. For example, the flexi cap funds or the large cap funds which are available to investors, create their core. Although business cycle, like I said, it is like having a flexi cap in your portfolio, but with more concentrated bets. So, it can be an addition and it can eventually be part of your core portfolio as well. But I don't think, it's the right fund to start off with. Eventually, yes. But I would also say that for funds, for investors who are having a lot of actively managed funds in their portfolios, and for example, the flexi cap and the large cap funds, they'll also have to, see the overlap with any business cycle fund, because as a fund house, I'm sure even in their other funds, the strategies, they are looking at sectors which have the potential to grow in future. So somewhere there may be an overlap. So I think it can be a good combination with passive funds in your portfolio. So I think in an active and passive combination, I think a business cycle can be added. And I think what they need to be careful about is that there will be periods of lag in even such funds. I mean, theoretically, all these categories look great, but I don't think that any sort of rewards can be possible without some sort of pain. And there will be periods of lag. There is high concentration to specific sectors. And of course, your predictions can go wrong in terms of which sectors or, stocks would do well, even in a business cycle fund. So I think if investors are aware about all of that, then definitely to begin with, I don't think this is the fund for people who have been in the markets. Yes, maybe, start off, you can have.